Now, the second thing that we're going to be talking about is price. So price as a whole. Price as a whole. Along the way, I'll be chipping in why it's important. I mean, the reason why it's important to be relating price or and field orders to price. Now, so price, we'll be talking about different candlesticks, and then I will explain to you why the analogy behind them, right? So the first candlestick that we see mostly on the charts is something like this. So on the charts, on my chart, whenever you see a blue candlestick, it means a bullish candlestick, and then whenever you see a black one, it means a bearish candlestick, right? So this is black, and this is blue, right? Now, let me add wicks to this and then explain. Right. So for the purpose of beginners, I'll go ahead and label what these parts of the candlestick mean. Now let's move on to the anatomy of most of the candlesticks that we see on the forex market or any financial markets, right? So let's take this for example. No, okay. Say this is a bearish candle. Let's also have one for a bullish candle, so we can explain it in both ways, right? Say change it to blue, right? Yes. Yeah. So you have these two candlesticks right here. Now, the first candle stick that we'll be talking about is this. So from here you have this wick. Then from here you have this. From here you have this, and then from here you have this. Now, these two candlesticks, it's important to know the time frame that you actually see in these candlesticks. This is because if you see this on a higher time frame, say on a monthly chart, you see, let's say this on a monthly chart, this bearish candle or this bullish candle on a monthly chart. When you go down to a lower time frame, this chart would be, in a smaller candles. So you might literally be seeing, sorry, some things like this because it's starting from here. So and it's a bullish candle. So you might literally be seeing this a dip down here. Then it started going up right here. Started going up right here. So it got to this point, and then it closed right here. Right. So this is what you'll be seeing for the bullish on a lower time frame. Because of time, I don't know if I could be able to draw them in base, but if let's see if I can try. So then let's get rid of this first. So what I mean is that on a lower time frame, say the 4 hour and an hour, what you'll be seeing is that the market opened right here, dipped down to this, making a bearish move, making a bearish move. So it's black. Then from here, it decide it decided to go up again. So right from here, it did this. Now it's bullish. Mm, right up to this, and then it dipped back from here. You have a bearish candle now closing right here. So this is what you will see. So you see this one candle on, let's say, a monthly time frame. You go on a daily time frame, you see something like this. And even when you go on a more lower time frame, you'll be seeing more candles, right? More candles. You'll be seeing more candles. Now let's go into the anatomy of these candles. So what it means is that, say there was a price level. What this literally means is that, please look at this plus short dashes, right? What this means is that at the beginning of the day, mm, let me just increase this a bit. So what it means is that at the beginning of the day, price began right at what? Right at price 2. So price line 2 for bullish. For this bullish candle, price began right here at price 2, right here. Then it went to where? Price 1. Then from price 1, a rise up to the highest point, which is price 7, and then finally close for the day at price 6. Now, what you should be asking yourself, and the inverse is for the bearish. Price opened right at where? Price 6, went up to price 7, dropped price 1, and finally closed at price 2. What you should be asking yourself is that, why did price come down here before finally going up and then coming down to close here? That is where understanding and field orders comes in. Because when you know, or when you analyze your chart, to be able to determine where unfilled orders are, because trust me, unfilled orders are the orders that move the market. They are the orders that are placed by these big institutions, the hedge funds, the banks. Those are the orders that do us, that move the market. So as a trader, it is your responsibility to do your due diligence on understanding where these orders lie, so you could profit from them. And you do this by using technicals, fundamentals, and sentimental analysis, right? So this the only uh, analysis you can give for this candle, this bullish candle, is that price open right here, right? Now, for a trade to occur, you need both buyers and sellers. So let's say at this point, a store owner has, let's say, GBP card as an asset that he or she wants to sell, right? So he opens, or he places the assets in a marketplace for people to come and buy. Now, when you go, he or she tells you that this GBP card is $2, right? The starting price is $2. Now you think $2 is too expensive, you cannot afford, so you don't buy. So when the store owner realizes that, oh, this asset has been here for a very long time, nobody is interested, nobody's buying because the price is high, the only um, thing, or the only clever or intelligent thing the seller can do, or the shop owner can do, is to lower the price, of the assets so people can buy, or is to look for demand, to look for where whatever asset is selling is important for people to buy, where there is higher demand, right? So from here, at this price level too, now the shop owner reduced the price to $1. And at $1, there were a lot of people who needed the thing, but let's say they didn't want to buy the asset at $2. So as soon as it dropped to $1, see, this is how you think when you are analyzing the charts. So at this price level, it was too high. So he has to reduce the price, which he or she did, to $1. And at $1, a lot of people were interested. People had already even placed, and filled orders here, which in this case are what? Limit orders. That as soon as this asset drops to 1, I want to buy as many as I can, right? I want to buy as many as I can. Now, as soon as it dropped to 1, all those unfilled orders were now filled. They were what? Now filled. People were buying. People were buying. Now, what happens to the price of anything when a shop owner realizes that that asset, a lot of people are buying? He or she raises the price. So what? There is demand for it. A lot of people want it. Once the shop owner realizes that there is demand, he or she raises the price, and that's exactly what happened in this phase. So as you can see, it opened at $2. As soon as it dropped to $1, a lot of people jumped on it. So when a lot of people jumped on it, you can literally see what happened to the price by this uh, candle formation. It what? It also rised. It rised. So from $1, it went to $2, it went to $3, it went to $4, it went to $5, it went to 6, and finally 6. Sorry, 7. It went to $7. As you can see, it went to $7. And at the bottom here, $1. It's not retailers who move this market. No, it is people who are buying millions of shares, people who are buying lots of shares that moved this. So they bought here at a very low price, and they bought a lot to what? Cause the shop owner to start raising prices, right? So price was raised until it got to 7, and then 7 at 7, there was nobody who was willing to buy again. So before the day closed, he still had some shares, some assets that he needed to sell. The shares, the assets weren't finished, so he had to do what? Price has to reduce, and he reduced to 6. Still couldn't find any buyer, so he closed for the day. That's literally what this bullish candlestick means, right? And for the bearish candlestick, which is this, right? So for this candlestick is for the bearish market when the market is in a downtrend. So what this means is that the market opened right here at $6. As you can see, the market opened at 6. Now, when it opened, people were still in the market who wanted to do what? To buy the assets, right? Some people still wanted to buy the assets. So they bought right at 6. And when people are buying, prices go up. So prices now went to 7. As soon as it got to $7, nobody was now interested in buying the assets. Nobody was interested in buying the assets. So what has to happen to the price of the market? The price has to fall to attract buyers, right? And trust me, at $65432, there are a lot of retail traders who will be willing to buy, but their orders are not large enough to cause the shop owner to do what? To start increase prices. No, they are not large enough. So until it reaches a price level where large orders start to come in, there is no way as a shop owner you are going to raise prices. So what happened is that the shop owner came into the market with his assets selling at $6. So that's how people were buying. So he raised his the price of the asset to $7, and at $7, nobody was willing to buy. So it has to drop. It was dropping. It dropped to 6. Didn't see any big orders coming in. Dropped to 5. Didn't see 4, 3, 2, and then when it got to 1, that is where he realized that this is in a very discounted price, right? So some people started buying again here, but the order was not too many, but it was enough to cause the shop owner to raise prices to 2. And at $2, it was at the end of the day, and the shop owner had to close. So literally, that is how you what this is the analogy, or this is the thinking process you go through when you're analyzing charts like this, especially on the monthly time frame. So say you have this bullish candle, and then the next candle is starts right here at the closing price. It opens here, comes down here, right? Makes a wick here, drop down to say 4, right? And then there's another candle that comes in, closes here, so it also starts here, goes up here, right? And this is blue, right? Right. So what this literally means is that as I explained, market was opened at say, so let me add more. Okay, right, right. So what it means is that market opened right here, didn't get buyers, so has to go into discounts to find orders. It came down, found orders, went up to this highest points. People were no more for the day. People were no more willing to buy, so it dropped here and closed here. So it didn't find no buyers, so it closed here. Now the following day, market opened right here at $6, which is the same price it closed the previous day, right? So it opens here $6. Now there's two no buyers. What do you think the shop owner is going to do? He has to reduce the price. Now it went to 5. Still, people are not there. People don't want to buy there. So it went to 4. Then at 4, that is when we saw buyers coming into the market. And then from 4, it went back to 5, then closed there for the day. Then the next day, it opened at exactly 5, and it went up to what? 9, then dropped back at 8 to close for that day also. So what it means is that the orders picked up here, right? That caused this market, the orders at 1, that caused the market to move to 7, which came to 6. Then the following day, it also dropped here. It means that at this price level, which is 4, big orders now started coming in. And these big orders come in from who? The big institutions, right? They also move the market price. They did move the market prices what's above again. So as a trader, it is your responsibility to do what? Know or analyze to understand where these big orders would be, right? And that is where the concept of supply and demand comes in. But so far as you've not gotten there yet, let's not, be in a haste. So you understanding this, let's take another example. Let's do with another example, and right. So let's say for this, you have, a smaller body. You have a smaller body, and then longer wrists. Let's explain this, and then we'll be done for this. So you have a smaller body, and then longer wrists, right? Yes. Yes. So this will be faster because we've already delved into it with the previous explanation, right? So with this, market opened for the bearish candle. Market opened right at 5. Then what happened? As you can see, it moved up. It moved up, right? Why did it move up? Because at this low level, orders were still coming in. Orders were still coming in. So it moved to 7. And at 7, orders were no more coming in. So the owner has to give a discount, right? So it dropped to 7, sorry, 6, still found no order. It dropped to 5, it dropped to 4, it dropped to 3, it dropped to 2, it dropped to 1. When it dropped to 1, that was when it was low enough to attract orders or investors. So we saw a lot of orders coming in, right? Until it got to 4, no orders were coming in, and then the market closed for the day. So for the bullish candle, it opened right at 4, went down because orders were not coming in to 1 to gather more orders, right? Once it got the orders, it moved to 7. Moving to 7, no orders were no more coming in, so you had to continue giving discount to the day closes, and then the day finally closed at 5. So with this, I hope you've understood, the anatomy of candlesticks. When you apply this knowledge to all other candlesticks, I hope this will help you improve on your trading journey, right?